Welcome back. Before we get into the details, check the link below for the Healthcare Reimbursement Gap Calculator to see where your cash flow actually stands in 2026. It's Thursday night. You've treated hundreds of patients, but the operating account is nearly dry. Tomorrow is payroll, and the entire operation is stalling because of a banking delay, not a clinical failure. This is the reimbursement gap, the financial chasm between delivering care and receiving funds. While typical businesses collect within 30 days, behavioral health waits 65 to 75 days. You're floating interest-free loans to insurers. Worse, complex utilization management means 60% of denied claims are never resubmitted. That trapped revenue simply dissolves. The reimbursement gap is a systemic cash flow trap built to pressure independent operators. To see why the system is built this way, look at the rise of vertical consolidation. Huge conglomerates now act as the payer, the provider, and the lender simultaneously. When your insurer is also your biggest competitor, they have a financial incentive to use stalled payments and complex authorization cycles to drain your reserves. Once starved of cash, these entities offer high-interest emergency loans to cover the shortfall. Practices that default on these emergency loans are often acquired by the conglomerate at a fraction of their clinical value. Participating in this system without a defensive financial strategy leaves an independent practice highly vulnerable to this cycle of acquisition. Defending your practice requires what we call the two-step move. Step 1 is building the bridge. Modern AR financing or invoice factoring access this bridge. It converts those 65-day stranded invoices into liquid cash within 24 hours. Unlike traditional banking with its manual wires and afternoon cutoffs, modern technology-driven factoring provides automated 24/7 funding the moment a claim is verified. If you're looking for ways to stabilize your cash flow, subscribe to the channel and visit BusinessLoan.Directory. Financial speed requires regulatory discipline. Under the 2024 updates to 42 CFR Part 2, handling substance use disorder records requires strict business associate agreements to ensure every vendor meets HIPAA standards. AR financing stops the immediate cash flow crisis, provided you maintain flawless regulatory hygiene. Once you've bridged the immediate gap, you move to Step 2, the SBA exit. This involves refinancing short-term debt into long-term stability using an SBA 7A loan. Because the federal government guarantees these loans, lenders can offer lower interest rates and 10-year terms. This stabilizes your overhead and protects your clinical autonomy. There is a lethal trap in this transition. As of June 2025, SBA regulations explicitly prohibit using a 7A loan to refinance a merchant cash advance, or MCA. Accepting an MCA for a quick payroll fix permanently blocks your path to SBA refinancing, locking the practice into a cycle of high-interest debt that often leads to default. The choice of bridge capital determines whether the SBA door stays open or slams shut forever. Executing this playbook ensures liquid capital reaches your operating account within 24 hours of care delivery. The Friday payroll is met, and the Sunday night anxiety over the practice ledger is replaced by a predictable cash position. Mastering this working capital formula is a proven defense against corporate consolidation in 2026. Use compliant AR financing to bridge the temporal gap, and leverage an SBA 7A loan to secure long-term stability. To find the right capital structure for your clinic, visit BusinessLoan.Directory to pre-qualify across a network of 75 specialized lenders. In the year 2026, clinical excellence must be paired with aggressive financial planning to maintain an independent medical practice.